Hey, Ren, I was thinking, do you own any of the massive companies in the US?
Nah, mate, none of them.
Yeah. Why is that?
Too expensive. I mean, Berkshire Hathaway goes for like $290,000 a share. Amazon is like $1,500 for one share. Hell, I can't even afford Netflix at $300 a share.
Yeah, well, instead of waiting around for a pay rise, there's no need for that anymore because our friends over at Stake, they've solved this problem for you.
Really? Tell me more.
So Stake is the simplest way to trade US shares. It's a new Australian company that's just started up, and they give you access to over 3,000 stocks and ETFs over in the US, and they offer you $0 brokerage. You can also buy partial shares, meaning, Ren, that you can finally buy $100 worth of Amazon if you really want to. And you know what the best part is?
What's the best part?
Now we've teamed up with Stake over here at Equity Mates. That's you and me, Ren.
Yeah.
And we're giving our listeners the ability to sign up with Stake and get $25 in their account to get them started. So if they head to equitymates.com/stake, STAKE, sign up and fund their account, Stake's going to swing them $25 into their trading account to get them on their way. So that's free brokerage, the ability to buy partial shares, so you don't have to spend $1,500 on an Amazon share. You can buy $100 worth if you really wanted to, and $25 to get you going. Mate, you're almost halfway there to a Berkshire Hathaway.
Berkshire Hathaway. Mate, with that free $25, I could get 0.01% of a Berkshire share for free.
I mean, it's a win-win situation, really.
You know what? I reckon if I held that 0.01% of a Berkshire share for like 80 years, I'd be set for life. I'd retire in luxury.
Well, get started.
Yeah, I'm going to right now.
equitymates.com/stake.
Stake, STAKE.
Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
We're here in the BetaShares offices for our third part in the three-part series that we've done with them, focusing on exchange-traded funds, or ETFs. If you haven't listened to the first two, definitely go back and listen to them as we speak to one of the founders of the company and a very intelligent and insightful man, Elon. He discusses ETF 101s and gives us a bit of background into BetaShares, the company itself. So fantastic two interviews. Go back and listen to them. So this evening we're joined by Adam, who I'll let him give himself an introduction. But today we're going to be talking about three very exciting concepts. We're going to be talking about investing in tomorrow. We're going to look at tech giants, hackers, and environmental sustainability. So three massive industries that, positioned correctly and with a bit of research, these three industries we believe are going to offer some great growth potential. I mean, they already have been, but in terms of investing for the future, these are very exciting space. So based on what we've heard about Adam and some of the content that we've been going through with him, this is going to be a very exciting next 40 minutes or so. So Adam, can you just tell us a bit about yourself and what you do at BetaShares?
I guess my title's manager of distribution and capital markets, but I think what that really means is basically, I think with my role, I talk largely to our broker and IFA intermediary groups on a day-to-day basis. Also do a little bit with retail and clients, talking at a few of the SMS seminars and things like that.
Do you just want to give us a brief background into yourself? What did you study? How did you end up in BetaShares?
Yeah, so I did law and commerce at university. Decided very early that I definitely didn't want to be a lawyer.
Yeah.
So went down the commerce track. I started out with Bell Potter, or one of the, I guess, larger broking firms in the country. Went through the DA and associate advisor and advising a few clients and SMS clients there. Actually worked quite closely with the BetaShares guys in the early days. NASDAQ, when it launched, was actually, I jumped straight on board. It's was always one of my core portfolio holdings with guys that I was talking to and in my own portfolio. So it's sort of a natural thing that I find quite easy to talk about with clients. And so I guess progressed into this role. And I guess a lot of what I do, as opposed to talking to end clients, is talking to the advisors who advise those clients. And I think Alan probably mentioned, but we're seeing, a big transition in that world away from single stock picking and strictly, broking based to more fee based holistic advice models. And what you've got with ETFs, which is, I think, one of the big advantages, the access to diversification type thing that we're always talking about, is particularly for advisors and their clients, it's allowed them to build a lot more robust portfolios. So very much my role is talking to advisors and communicating ideas to them about how they might be able to use certain ETFs to build out these client portfolios in asset allocations to Australian equities, global equities. I think you're talking about some of the fixed income using things like the short ETFs as a hedge. There's a lot of ways that they can utilise these things to really create a lot more robust portfolios, and say they might have in the 80s, 90s, where a lot of it was just, your large cap equities and small cap equities, and diversification was how many stocks you held.
So the first big theme that we want to talk about is technology, which seems particularly relevant for you because you were saying that you jumped on the BetaShares NDQ ETF early in the piece.
Yeah.
So maybe to start this conversation, why did you jump on it so early? What attracted you to that particular ETF and the NASDAQ as an exchange?
Yeah, well, I think if I talk about it that way, it's also talking about how I'm seeing other advisors using it.
Okay.
Because I think how I was using it is a bit of a roadmap, and I think if you look at the way that we naturally invest in Australia, when I was taking a look at the portfolios that I was looking at, and then when I talk to advisors about the portfolios that they're looking at, you're naturally heavily invested in Australia in our large cap equity market. A lot of Australian investors are invested for income. Yeah, and a lot of offshore investors actually invest in Australia for income. We do have one of the highest dividend yields globally, right? But if you actually take a look at our market, it's very unique from a global standpoint. We have 4 big banks, about 50% weighting to financials. When you broaden that out, you've got a couple of massive miners, some energy companies in there, a few AREX staple securities, 2 supermarkets, and there's your top 20. Pretty much, yeah. But they have been great stocks for a long time. They definitely show growth, particularly the property boom. These are residential mortgage lenders, BHP and Rio. They have their ups and downs. They're quite cyclical. But Telstra even performed for a long time for the kind of investors that were in them for a while. But the reason that I guess attracted me to NASDAQ is it's giving you exposure to looking out the windshield and trying to position your portfolio for the future. And the kind of companies that are in the NASDAQ really are the kind of companies that you just don't have in Australia. And that's not saying that Australia doesn't have any growth. Our Index X20 actually performed very, very well last year. And we've got an X20 fund that did over 20%. So there's definitely growth here, but I think they're in isolated pockets and they're not really in a diversified way. What I want exposure to is I want exposure to the big companies and the big themes that, if I look down the track, are going to be dominant in the world that I see.
We should just say, I don't think we specifically mentioned that the NDQ is what we're discussing is the top 100 companies on the NASDAQ.
Yeah. So top 100 companies on the NASDAQ by market cap. So look, you end up with Apple, Amazon, Facebook, Google.
The big ones.
They tend to decide a lot of the fortunes of the index, really. I mean, outside of that, it does actually have a lot of interesting things in it, away from what I'm talking about, a lot of innovation in medicines. I mean, anyone who owns CSL knows what they've done recently. We've got one stock in Australia. They've got an index that's full of them. You actually go down the index further, and some of the real, you're looking at NVIDIA, gaming chips, Activision, Blizzard. There's a lot of that esports exposure in there, which I've always found quite interesting in terms of broader long-term thematics as we're talking about. But I mean, the guys that are really driving the performance here, and I think the ones that you want as a core exposure, and this is what I talk about NASDAQ as. So NASDAQ, because of the companies that it holds and the size of them, they're core exposures. You're not just investing in them as tech. I think the 5 biggest companies in the world are your 5 biggest companies on NASDAQ now. So, I mean, and I just don't think, that's in a position to really change anytime soon. These guys are exceptionally dominant. Amazon basically destined to win because anyone playing against it, if they're playing poker, Amazon's got all the chips. I mean, we saw it recently. Facebook's essentially killed Snapchat.
Yeah.
They took Snapchat's story feature.
Yeah.
Anyone who's been on Instagram knows that you just put your Instagram story up now.
Yeah.
Was it Kylie Jenner effectively crashed Snapchat with a tweet saying who still uses this?
Yeah.
The thing plummeted. So they sort of have that ability to go in, see what someone else is doing, and just put it on their platform.
So when you look ahead and you look at the themes driving this technological dominance, do you see those themes extending into the future, or do you see the disruptors being disrupted?
No, definitely. So I'll probably take this in terms of it's all about data, and it's all about the big digital, we call it the digital platform companies: Apple, Google, Facebook, Amazon. They control the data. It's a pretty common phrase now. I mean, I think The Economist coins it, saying data's the new oil. So the world's most valuable resource is no longer oil but data. These guys, they control your data. Apple knows everything you do on your phone. Google knows your search habits. Amazon knows your shopping habits. Yeah. Facebook's your news platform, knows what you're doing. So it's all about data. And I think when you look at the tech world and you look at where we're at now, we're sort of in this fundamental shift. And I think we're moving into this phase now where these guys start to really take control. So about every decade, there's one of these shifts. If you look back, there was, they called it the PC hardware era, where, IBM, there's a PC on every desk was their thing. Then we moved into the smartphone. Mm-hmm. And now the smartphone penetration, I mean, the average person spends 5 hours a day on their smartphone. And there was the smartphone wars, and Apple and Android ended up winning that. Yeah, they're the only two operating systems in there. Now they say we're moving to the sort of the cloud data era, and this is where it starts to get interesting for these guys. It's because data really controls everything that's moving forward from here. I mean, you've got the emergence of the Internet of Things, where everything's connected. The Internet of Things is basically a way to talk about your Fitbit talking to your phone. Just all these different devices talking to one another. I think the interesting thing with that is, they're going through this phase where you talk about, services revenue for them. I think Apple's latest earnings was the interesting one, where their services revenue jumped 30% year on year from the March quarter. So Apple's now, iPhone sales are stagnating, but they're now being able to use their data to just create all this subscription revenue. I'm guilty of it. I went to move to the iPhone X, and there was so much data on my iPhone because I've got 8 years worth of photos on it.
Yeah.
Couldn't back it up onto my computer because it's 60 gig worth of data. And so you're sitting there and you go, okay, so I paid for the cloud. Yeah. And now I'm just using iCloud and I don't even notice it. And my photos update automatically and I'm just paying. I have a Spotify subscription, a Netflix subscription. I'm just subscribed to everything.
Amazon Web Services as well. Like, they're incredibly dominant now.
Oh, absolutely. And that's where they're moving to. Is, Amazon's smart. They're the 5th biggest spender on television production last year in the US.
Really?
A lot of their rings.
These guys, a lot of the rings, they're diversifying their revenue stream. So this is where it starts to get interesting for these guys. Google's probably the real interesting case here, because the only thing they've probably barely scratched the sides of what they can do. The only thing they've ever monetized is search engine advertising, really, using your search habits to advertise to you. But now they're on YouTube. And think about YouTube. So the advertising industry globally is a $500 billion industry. YouTube currently captures $6 billion of that. I mean, that's it. They have so much capacity with YouTube to dominate the TV landscape that they have just this huge pool of revenue. Honestly, so Facebook just bought the World Surfing League, right?
Really?
Yeah. Facebook now own the television rights to the World Surfing League. Wow! I would take a bet from anyone that within the next either the Soccer World Cup or the Olympics before 2025 will be owned by YouTube.
Yeah.
Without doubt.
Or Amazon will come in and
someone will buy it, and it'll be all online. And so this is disrupting everything.
Yeah.
So they're disrupting the TV industry, and I talk about, and this is where we're talking about positioning for the future. Is because if these guys are disrupting everything you do, it creates disruption across everything. One of the best things I talk with the advertising thing, right? you can advertise on Google, YouTube, Facebook in an exceptionally targeted way. These guys know so much personal information about you that your internet's essentially personalised, right? And that's the whole thing about all this data, is that it tailors it to you. So where all these big defensive companies built consumer brands around their ability to just dominate share of voice. Think of Procter & Gamble, right? Procter & Gamble own every big brand. Do you know why those brands have been so big for so long? It's because no one else would get on TV. And you buy what is jammed down your throat. And that's all you could do, was you watch TV and they told you that you were buying, Colgate toothpaste, right? Now all you buy is Colgate toothpaste because that's on TV. But then you start to get all these tailored messaging, and it lets these smaller players come through. One of the best examples I've seen of it is, look at what happened to Billabong clothes. They used to have it, and now Facebook's allowed it. Facebook, when it came through, and Instagram have allowed all these smaller surf brands to come up. I mean, look at Thrills out of Byron Bay and all these, I'm from the Gold Coast, I've seen them all come through, but they can hit you on Facebook, they hit you on Instagram. I haven't seen anyone in Billabong clothes in years, and the share price is tanked and it's all over. Surf Stitch is tanked because no one buys the big name brands anymore. They're starting to revitalise themselves by picking up these smaller brands, but that's just a very small example of what can happen to these big defensive companies. So you could buy the S&P 500, which has a lot of these defensives. It has your Walmarts, it has your consumer defensive names, but they're all structurally seriously under threat by all these little changes that data's driving. Look at the personal assistant market, right? So you're talking about Alexa, Google Home, Siri. So fun stat I was reading when I was looking at this. Between Google Home and Alexa has had the fastest uptake of any technology in the history of the US.
Wow.
Little personal assistants.
Wow.
They've only been out for less than 12 months. So it's essentially a war going on at the moment over these personal assistants to see who wins. It's like the old... And at the moment, they're a fun toy. Oh, what's the weather doing? But if you saw Google the other week release the Google Assistant making a phone call, I mean, that was scary, right? How good it was. So these things are taking over. And then when the personal assistant comes in, think about this world, is you've got Amazon linked up to your Alexa, and you've got, we talked about, Colgate toothpaste. Well, you go, Alexa, I need to buy some toothpaste. You think Amazon's going to stock Colgate? No, you'll be having Amazon toothpaste. Amazon don't even sell Duracell or Energizer batteries.
Wow.
So your batteries in your remote come out.
Yeah.
You go, oh, you think you can get that? No, I need some batteries. Bang, Amazon.
Yeah.
The next day at work, Amazon batteries arrive at your desk. I mean, we're only really, we're looking at penetration in the US of 50% of all online sales go through Amazon. Right? It hasn't even happened here.
Yeah.
So this is what, I'll revert back to an investment sense because I do like talking about these stories, but you revert back in an investment sense, you go, why would you own Woolworths? When why would you want a long-term investment? Like I'm talking, I'm actually an investor in Woolworths.
I work for Woolworths.
There you go. I've had a good run on catching the rebound. What I was saying is long-term. This is all about long-term positioning. As I said, the three of us sit down and we look at our portfolios and say, we're trying to build these things so that we've got something to retire on, right? In a world where data takes over everything, personal assistants, your phone talks to your assistant, talks to your fridge, talks to your car, and it knows everything about you, and this whole internet is deeply personalised, and your stuff's just auto-filling itself, and Amazon's dropping it at your door, is if Amazon knows everything you're doing, you're just ordering through them. And that's where you end up in a world where your consumer defensives may struggle because they're not able to have the share of voice. You're getting whatever Amazon gives you, and it's just doing it automatically. And you'll just end up tied to it. You won't even think about it, and you'll go about your life because it'll be so easy. Structurally, buy these four stocks because they're just too powerful now, and the world's moving towards where they want it to be.
So I guess here's the question that comes out of that. If there are the four that are just so dominant, why would you buy MDQ? Why wouldn't you just buy the four?
I mean, MDQ is quite dominant, but the other thing, there's a lot of opportunities for other things to come through. So, NVIDIA's the chips in all these things. So they've made huge earnings. I mean, the other thing is, I'm talking about advertising revenue on YouTube. You know what the second biggest sport in the US is now? Gaming. More people watched esports last year in the US than watched the NBA.
I went to South Korea a few years ago, and it's like their national pastime.
Oh,
Yeah.
this is huge.
We've got the AFL team buying esports teams.
So they had, I won't remember the exact stats of the numbers on this. So they had a draw in the US. So they're creating a league. I think it was for, what's the one they're all playing at the moment? It's not Fortnite.
StarCraft.
No, it's not StarCraft. It's not Fortnite. It was another sort of first-person shooter that's not Call of Duty. Anyway.
You're asking the wrong people.
Yeah. Anyway, so this is the first-person shooter they're playing all at the moment. They were creating a league for it, and they sold league rights. You know who bought every single league right? Was an owner of another professional sports team. And the numbers they paid were eye-watering. So these guys all own esports teams. Now, esports isn't going to be played on the ESPN. Esports will be played on YouTube.
Yeah.
YouTube get the advertising revenue from that. But you want to buy NDQ. You got Activision Blizzard in there. You got Nvidia who are doing the gaming chips.
Yes.
You do have a lot of other things. So Expedia's in there, Priceline, you've got TripAdvisor. There's a lot of these other web companies that, yes, these guys are controlling the data, but they're still directing them to, TripAdvisor's finally been able to monetize their platform. Great platform. I've used it when I've travelled for years.
Yeah.
Now they're finally able to now they've been able to monetize that in terms of, you're travelling here, put in your dates and we'll find you the best hotel, that sort of thing. The big guys are controlling the data, but where you're actually getting a lot of good growth out of the things that move in on the other end.
Yeah.
I don't know if you're here for the conversation before where we said we have our sort of hypothetical portfolio for our listeners, but we put NDQ in, I think, almost a year ago as well, wasn't it?
Yeah.
We bought it at $12, I think, so it's now 16 something.
Yeah.
It's doing well, but as always, as we said before, everything comes with a risk. And very briefly, because we've got a couple of other things to move on to, but, with the recent problems that have come through with these big tech companies, Apple has been done for a data breach and, they're facing a lot of scrutiny now from regulators. Do you think that this is going to impact these companies going forward? Like, they're going to come under much more scrutiny. It might start to affect their earnings, these sorts of things.
Yeah, so regulatory risk is certainly probably near term one of the bigger concerns for these guys. Now, Apple, for example, go through it later. Actually, removed it from our ethical fund just because of that broad controversy and were they responsibly using it and did they do it appropriately? There's a number of incidents. Now, ultimately, we think that they will likely clean up their act and come out with ways to really use this data more responsibly. But with regulatory risk and regulators trying to come to terms with this data world. There may be some near-term volatility. Ultimately, you're talking about positioning portfolios for a very long time here in a changing world. So, do you buy pullbacks in it? That sort of thing. Do you wait for your entry points? You're sitting there. But ultimately, I think long-term, are we overly concerned? Should you be overly concerned really about, tightening regulation on someone like Facebook's business model? And I think, probably not so much. Facebook's core business, it's about using consented data to target advertisers. They don't have to share that data with the advertisers to be able to generate money. They basically can target this info without ever telling the advertisers the data they've got. And as long as that data is held tightly, which it largely is, the Cambridge Analytica thing was a bit of an anomaly, and that's really been stamped out. They probably should have seen it in advance, and they should have actioned it when they found out about it, which is two big problems. But now, the whole thing with that was, a third-party app then got access to all of your contacts. That was obviously just an oversight on their end, and then they sort of tried to sweep it under the rug. So that's a big problem. But ultimately, okay, you clean that up. Their business model essentially is not reliant on them sharing data with advertisers. The advertiser just says, I want, go back to the surfing thing, I want 18 to 30-year-olds who are constantly checking SwellNet every day, and I want to make sure they see my wetsuits. And there you go.
Yeah.
Facebook, that revenue model is intact. They don't have to tell the guy anything. They'll just make sure you're advertising targeting.
Yeah.
So, yeah.
So I guess that's a good segue into our second theme. If data is so valuable and, it's the new oil, well, then people are going to try and steal it. So that brings us on to cybersecurity, which is also an ETF that BetaShares offer. So I guess to start with, why is cybersecurity A, so important, and B, a good investment?
Okay, so We talked, it's a really good segue actually, and I think these two tie together exceptionally well because you just talked about regulation being a risk. What are the regulators going to demand more protection of data? So even if you're holding these guys in way about regulatory risk, well, regulations come in, require them to protect it. Well, your cybersecurity companies win in that world, right? I think, the interesting thing about something like investing in cybersecurity is really in investing you want to take, this is the core, this is the big theme. Maybe I look at it, would I take a layer back and I go, who's the real winner in this world? And I think in a world where data is so important and automation as well, like you're cutting people out and, you have laws around people stealing data or individuals taking private knowledge away. Well, you replace them with a machine and someone can get into that machine. Well, you've got to pay to make sure that thing is walled up. I think Morgan Stanley did some research and they were talking about banking data and cloud storage, for example. And they said about around the leaders in their research coverage universe, about 20% have got cloud data storage. They estimate 80% of banking servers will be cloud-based by just after 2020. Right. That's a lot of banking data stored online. So you've really got to be able to wall that up. That gets expensive with all this data moving around. It's increasingly complex. I think some of the stats are pretty interesting on this, right? Yeah. So I've got a few of them here because obviously I don't remember them all. But so there's things like, so cyber attacks are the fastest growing crime in the US, right? So Symantec, who are one of the big companies that hacked it, they reported that ransomware infections doubled last year. This is how quickly this is. Ransomware attacks doubled from 2016 to 2017. About 25% of those hit businesses. The FBI estimated last year that ransom payments, close to $1 billion, people just paying. At a government level, so the US government has identified this as the single biggest threat. The US government spent $19 billion on cybersecurity last year. That was up 36% on the year before. So you're getting these huge increases in attacks as things become more connected and as data becomes more valuable and automation comes into play more. And that just becomes a bigger line on every business, and the winners are the guys who obviously have to provide these services, right? One of my favourite ones is that so Cybersecurity Ventures, they run. You can access their report every year. It's quoted by pretty much everyone in terms of statistics. We look at it. The other guys who run cybersecurity ETFs in the world talk about it a lot. But they said that cybercrime at this rate is going to cost the world about $6 trillion annually by 2020. At that level, it's more profitable than the trade of all the legal drugs combined. Wow. So there's obviously not one Pablo Escobar running around holding it all, but this is just a world where these guys get in, they get their ransomware, and they charge you a little bit. Anyone who knows a small business comes in, they're like pirates, and you just end up paying them. That's why they're saying the ransom payments came so much because they don't. It's a bit of an honour among thieves thing. They don't ask for the world. But they do these little things and they go, oh man, that's kind of affordable, so I'll just pay. That's what ransomware is. Right? So
it's an interesting one because it's a space that I'm certainly interested in and have trying to get my head around the companies that are in this space because they're not the well-known household names of Facebook and Amazon and Google. Not. But I mean, from what you're saying, it sounds like there's going to be incredible opportunity for some big name players in this space to make a lot of money over the next couple of years.
So the big name players are really consolidating at the moment. This has been it's been a hot space for activity. Ultimately, it's one of those things where there is a handful of really big guys doing this, and it's like the big guys in this, like Amazon, Facebook, Apple. They're consolidating the industry at the moment. This is what's happening. It's probably real benefit of an ETF. I think that when you're talking about thematic investing, that's where ETFs really start to shine. We could all understand that cybersecurity is a great thing, and this is going to be a massive industry. But as an investor, it's very difficult for us to not only identify the theming of that, right, but then to identify which company. And then as an Australian investor, having to look offshore where we have very little information edge because there's just not that many in Australia that we can get exposure to. So it's sort of a case of, yes, I get the theme, I'll use the ETF. And so we've got 33 companies in this index, right? Now we have liquidity filters so that we're not buying everything that tells you it's a firewall.
Yeah.
You know, you actually have to be a real company.
Yeah.
And now a lot of these companies are in exceptional growth phases. So, you know, they're not, most of them just like big tech companies do. Amazon only just reported a profit, and I think they did that accidentally. Amazon Web Services just ended up making so much profit. I mean, Jeff Bezos has never not reinvested in himself in his whole life. He's probably the greatest manager of our lifetime.
Yeah.
So these guys are all reinvesting themselves and growing. But yeah, I think that, you know, it's an area where we're seeing a lot of consolidation and the big companies really thriving.
So just on that, I don't know if we've touched on it yet, but BetaShares offer an ETF in the cybersecurity space called HACK, HACK. And I'm just looking at the info sheet here. And so the last month fund return has been 4.99%. 3 months has been almost 15%. 6 months, almost 17%. And year to date is almost 20%. I mean, that's huge numbers.
Oh, I mean, it's similar numbers to what you're seeing in the tech. In tech, that's actually similar numbers to what our X20 index did. So everyone's remembering that if you actually rip out the large caps in Australia, we did over 20% for 2017, right?
Wow.
So NASDAQ did similar things. Like Google did 30% last year. They grew their earnings by 25%. So for a sector of the market that has this much growth potential, it's really been actually going in line with the market. It's not flying through the roof.
Yeah, right.
And considering, I mean, you look at, so Palo Alto is the biggest holding in
Never
the
heard of them. Have you?
Yeah, never.
They're the most. They're basically the big guy. They are fully diversified and they are growing rapidly. So I think the numbers are last quarter the company, 53% year over year customer growth. So these guys are reinvesting in themselves heavily to capture growth. And ultimately, again, I don't think you're paying outlandish valuations for the kind of growth you're seeing in this index, and especially not for something, it's still a thematic product. It's not, we talk about core and thematic here in investing, right? So Amazon, Facebook, Google, a lot of these NASDAQ companies, this broad index, very much core. You can sit there and go, they're the ones that you want to be, your big, large caps. Whereas HACK probably sits in the thematic bucket, which for most people would be a smaller part of the portfolio. But, I think you're still buying an area that's just got potential for exceptional growth.
Yeah.
If you believe ultimately that, data's the new oil and these guys are a new commodity producer and it's going to be such a big industry down the track, you're not paying outlandish valuations.
So let's move on to the third theme, which isn't related to technology per se. It's about ethical investing and investing sustainably. This is a funny one for me because my first question whenever I hear about an ethical fund is, how do you determine what is ethical? Like, what standards do we...
Hippies, isn't it?
Yeah.
Very difficult.
Because, one man's ethical is another man's not ethical, I guess.
Exactly.
So what does BetaShares
What do we do?
Yeah.
We take the broadest approach possible. Look, our Ethic Fund, ETHI, that's our global version. We end up with 100 large cap stocks.
Okay.
We start with at 6,500. We end up with 100. When you're going for 100, it lets you be pretty strict, and you do end up with the big end of town in there a lot of the time. But we took the approach that you've got your negative exclusions, and then we wanted some positive screens as well that promoted environmental sustainability. On a negative exclusion basis, we tried to be the strictest, and we believe we have the strictest screen for the Australian market. And you generally find that, people are either investing, a lot of them are on morality grounds or, investment mandates that constrain them from investing in certain things. And you end up with a lot of armaments, alcohol, tobacco, firearms, pornography, that sort of thing. And then you've got a lot of environmental investors, and most of them actually don't mind crossing over. And so for a lot of the environmentally conscious investors, that's where we come in by excluding fossil fuels, excluding fossil fuel lending. And that's where you end up. And in the world of, socially responsible investing, we've actually found that crossover. Neither side need to really mind.
So just with that, fossil fuel lending, so, if a bank is lending to BHP, Adani, they're out.
Our Australian version, FAIR, has none of the big four banks.
Really? Wow.
That's Bendigo, because Bendigo no longer lends to any fossil fuel projects.
Wow.
Yeah.
That is a much stricter standard than I thought.
We try to be the strictest. Because ultimately, there is conversation around you can use this as a core. And then if there's other things you don't mind, you can build out around that. But at least you know when you're buying an ethical product that is true to label. True to label drove everything we did with this.
Yeah. Do you find that some of your competitors are a little bit laxer, or is the screen pretty similar? Yeah.
I mean, what existed in Australia was nothing like this. There was an Australian ethical product listed on the market, for example, which only screen was for armaments. There isn't an armaments producer in the ASX 200, so you had an expensive ASX 200 fund.
Right. Yeah.
Seriously, that was a thing.
Yeah.
By market cap, it was the same.
So the top weighted company in the fair, the Australian Sustainability Leaders, is ResMed.
Oh, wow. There you go.
I want to talk about this because if someone who has sustainability in their mind in terms of, solar power and that sort of jazz, the top 10 companies here, you've got a bunch of healthcare, a regional bank,
so
a property developer. So it's kind of like...
so this is Australian. This is Australian ethical. And again, it comes down to the same thing that we spoke about before is, you can't... If we would only go and invest in companies that were doing, solar paneling in Australia, you'd end up with
nothing.
Pretty obtuse basket. This is a core for many people's portfolios, right? So it's as much in Australia as about excluding as much as the inclusions.
Yeah.
When we go to the global one, you can end up being you get a lot more data on the global. You can be, I think, a lot more positive in the environmental side. So we actually get data for the global one from Truecost or an S&P Dow Jones company, and basically what that is to get included. Once you've passed all the screens to be included in the index, you have to be at least 60% more efficient than the industry average. It's a pretty high hurdle. And very good for carbon efficiency, right? So your carbon footprint. I've got ahead of myself. The best example of that is Apple. So Apple made a commitment to have no carbon footprint across their supply chain by the end of 2018, and they're already there.
Wow.
So Apple doesn't have a carbon footprint. That's sustainability and caring about the environment. So they're actually making a positive impact.
That's incredible.
Yeah.
Because their supply chain obviously stretches to China and everywhere else and back.
Exactly.
How do they net that out? So, obviously they're using fossil fuels to move products. They're not using Tesla's shipping to get things.
They're doing a lot of environmentally positive projects.
Yeah. Plant a lot of trees.
There's a lot of their funds for basically those sorts of projects that net themselves out.
Wow.
And so what do you use to verify these sort of claims?
Truecost. So S&P Dow Jones compile the data, a group called Truecost, and we use the data that they provide. And it's basically industry leading. So they analyse all of that and pass it through to us.
And how often do you review these?
So interestingly with both, this is part of that, being true to label, is that we review every 12 months, we review the basket. But we also have a responsible investment committee, which we think is really crucial to this. So they're not there to make any subjective decisions. It's not an active fund, but what they do is that element of human oversight. So in ethical investing world, there's a lot of grey area. And best example, we actually had to pull Facebook out of Ethy over the controversy, so we removed it.
Okay.
And that was a decision of the Responsible Investment Committee, who we had the ability of human oversight to say, look, data's not really something that people have considered before, but Facebook's just shown that they've been, very lax in the protection of it. They let Cambridge in. They haven't got this isn't really someone who wants to invest in an ethical product. This isn't, their cup of tea. So we'll pull it out because we have that human oversight. So we have that review process as well.
Okay.
Yeah.
So with all these ethical funds, and I guess, this comes down to people's individual choices, but an argument that I've heard is that people shouldn't invest ethically, rather they should invest to make money and then spend it ethically.
Yeah.
What do you think of that?
Yeah, take a look at the performance of these two funds versus their benchmarks. So the actual data that's coming out about companies that have positive ESG practices and their performance, it's actually fairly astonishing. I've got something here that, where'd they go? They did some research on it. Morgan Stanley did it, and they looked over a long period and found that if you invested in a portfolio of businesses that monitored ESG, each dollar invested would have been worth $14 over a 20-year period. What was it? No, $14 was the benchmark, $28 was the ESG one.
Oh, wow. So doubled it.
Yeah. So if you actually have a look at the performance of Ethy versus the MSCI world, it's outperformed on basically every time frame. The only year it didn't was when there was a mining rally in 2015.
Right, okay.
Same thing with FAIR. You end up with a really good diversified mid-cap portfolio in Australia, which isn't necessarily a bad thing. You end up with a lot of exposure to tech and healthcare in Ethy. it's interesting. The other thing I think long term about performance that's really interesting to note is people are coming to ESG and away from fossil fuels is because, we're talking about investing towards the future, is why there is actually quite a tangible risk to the long-term sustainability of these fossil fuel companies. So, I mean, we can get our energy from the sun. Well, we can. We haven't worked out. The technology will find a way.
Yeah.
So the terminal value in these companies, it's not particularly great.
Yeah.
So, I mean, I think a real interesting one. So last year, this gives you an example of the real thoughts on the future for the fossil fuel industry. Is Norway's sovereign wealth fund sold all of their oil and gas investments last year.
Wow.
$35 billion worth.
Wow.
Which is ironic because a lot of that sovereign wealth came from oil and gas. Yeah.
Norway is one of the biggest deep water oil producers in the world.
Yeah.
They sold it all.
Yeah.
If Norway knows the oil market basically better than anyone. They're not the Saudis. They're not trying to rot the oil market or manipulate it. They just went. They obviously think that there may not be the brightest future in oil if the Norwegians who have intimate knowledge of it sold it all down. So there is probably a investment argument that investing away from fossil fuels, which could be structurally challenged, isn't necessarily bad for performance anyway. The intrinsic thought is, I'm investing ethically, I'm sacrificing performance. Well, by the time you run these screens over it, and in a world where technology is really driving everything, and it's not the old coal-powered, fossil fuel world where oil drives everything.
Yeah.
I think we'll wrap up there, Adam.
Yeah.
I just want to go back over a bit what we discussed. So we looked at technology, which was NDQ. So this can be found bought on the ASX.
Yep.
NDQ follows the index of the NASDAQ top 100 companies. So you Facebook's, Amazon, all that sort of stuff. And then we discussed cybersecurity. And that was exciting. Massive potential there.
Yeah, I've actually got an interesting one because I sort of went through it and I've got a good example that people quite like. So this will show you the scale of what can be done in hacking at the moment. So this was a recent one that Darktrace used and they didn't tell you who it was. So we talked about the Internet of Things. That's where a casino in the US a few months ago got hacked through the thermometer on the fish tank.
What?
In their lobby.
What?
So
You're joking.
Because all of these things, so this shows.
So it was obviously connected.
So yes, the whole thing. The more things that get connected, the more you've got to secure. And everyone's worked out that,
you can get it.
We've got this. Oh, we've looked it up. That's great.
Yeah.
They can get in through that.
Yeah.
So they got in through the thermometer in the fish tank, got into the main, and took the data for every high roller in the casino.
You're joking.
Wow.
So that was Hack, HACK,
Yeah.
an ETF that you guys run. Again, if you buy through the ASX. And then we looked at sustainability, and you've got Global Sustainability Leaders ETF, which is ETHI, ETHI, and it's
That's a global one.
And then you've got an Australian Sustainability Leaders ETF, and it's FAIR, FAIR.
Yep.
Both, again, found on the ASX, traded like normal stocks. And again, very interesting concepts and industries that are future-driven, I think.
I think you've given us a lot to think about.
Yeah, I'd just like to talk about a bit of what we're seeing in the world and the reasons I think why these can form parts of portfolios, particularly for guys like ourselves and guys and girls like ourselves who are looking to build our own super funds to last. Hopefully 30, 40 years.
Yeah, absolutely. Well, thanks for your time, Adam. It was very interesting. Really enjoyed it.
Cheers, guys. Thanks for coming in.
Thank you.
Hello, mates of Equity Mates. Or I guess that just makes you equity mates. Anyway, it's Bryce here. One of the most frequently asked questions we get is, where do we find information about all these stocks and where's a good place to start? Now, we could do a whole episode on this, and we often do touch on it, but the best place to start is by signing up to our Thought Starters weekly email. Each week, we send you some cool stuff that has caught our eye during the week, as well as some more detailed articles on stocks and invested relating content. We also include Basics 101. These are articles tailored specifically for beginners to really propel you on your way. We don't spam you. I mean, we hate spam. It's once a week and there's enough stuff in there to occupy you for a full day of browsing at work. Now, Ren puts a lot of effort into finding quality articles for you guys, so if anything, just sign up so he feels the love. Head to equitymates.com and chuck in your email at the bottom of the page.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.